Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. Learn from their experiences and navigate the highs and lows of the investing world. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody. Thank you so much for being here on this edition of the REI Hacker Podcast. I'm really excited to talk to our next guest, who is an investor. He's an educator, and he's the creator of an innovative strategy for investors to get their first deal or their next deal, and it's called the 203K way. I had a chance to talk with Matt a few weeks back, and I've used this strategy, but didn't know it could be such a big way of getting investors into the fold and getting them their first win or their next win. Matt, thank you so much for taking the time to be here. I'm really excited to learn about how you came up with this thing, because typically it's just for people who are looking to buy their first house, and their price range is maybe in a place where they can only afford a house that maybe isn't like perfect. So the FHA has this loan which allows them to get basically money up front to renovate the house and get it to a place where it's livable or make it FHA compliant. Mm-hmm. And you've turned this into a strategy and have a whole education platform around teaching people how to do this. It's really cool. How did you come up with this?
Awesome. So great question. And Benson, thanks for having me on, man. Big fan of everything you've got. And it was really cool that we got to connect about this. And it's always exciting for me when I hear when someone's that's familiar with it and jacked up with it. Cause I really do say it's real estate's best kept secret. And to your question, like, how'd I find out about this? Really by necessity, because I'm here in New York, born and raised. And New York is, of course, a very high cost of living place, just like a lot of US is right now. And like many people, I also was very interested in investing and money and everything, basically right when I got out of school. So the long and short of it was I grew up very in like a blue collar household. My parents had their own business. Money was very tight growing up, and money was very like almost the root of all evil in my house, right? It would always be kind of like a thing where like if money was coming in, everyone was happy. If money wasn't, everyone was not. And at a very young age, that really has a profound effect on you. And it did on me. And for better or for worse, I always had a focus on that. And I always wanted to learn, like, what is the way? I was always the guy that like, hey, I'm the person that like knew there's a better way, but would always be on the search to find it. And that's really how this all came about. Essentially what happened was, I got into my parents having their own business, told me to go to school, get a good job. And that's the goal, right? They had their own business. That to them, a consistent paycheck was the light at the end of the tunnel. And, of course, like your parents are there to make sure that what's the best for you, right? So they that's what they did for me. And it's not a right or wrong answer, but just for me, I did that, went to school for electrical engineering, started working for a firm in the city, kind of even during the craziness of the 2008 crisis and everything like that. But very quickly in that game realized that working the 9 to 5 and having the W-2 world wasn't exactly what it was cracked up to be either, and also didn't solve money issues. It's not how people get rich either. So like many people, I read the little book, Rich Dad, Poor Dad, that you may or may not have heard of. And for a lot of people, that's like kind of, I call it taking the red pill for me, because, it opens for a kid like me that grew up in a household where the word investing I don't think that word was ever said in my house growing up. It's just blue collar. The investing was not a thing. The money came in, it went out as fast as it came in. So I always wanted to do this. I wanted to invest. I read the book and, read about real estate and just couldn't figure out a way to get into the game. I tried a lot of different options, right? But because being in New York, being a young kid, I didn't have hundreds of thousands of dollars. Like many people don't, but to make matters even worse is like, a 20% down payment on a house or a property in New York is $100,000, right? The average home price, I mean, now it's $680,000 in my county, right? So the idea of putting 20%, 30% down, using hard money, doing that was really tough. And I tried even wholesaling, and to me, I couldn't crack it. In retrospect, I know what I did wrong, but you can imagine, like, I'm just getting really, really fed up and frustrated because I read the book and I read about real estate investing, and everyone keeps saying it's the best vehicle, but it's so unattainable for me, and it was so frustrating. And it wasn't until I went to my local REIA and I met this lady, Melissa, who ran the group. And I worked with her, and she mentored me because I kind of was like, hey, listen, well, maybe she has a better idea of what to do in New York because she's in New York and she gets what we're up against. And she gets maybe she gets it. And I took her to the side one day and I asked her, I was like, listen, I'm trying everything and I just can't find a way into this game. So, like, if you were me and you can go back in time, I'm like, I have a couple grand in the bank. I'm not sitting on hundreds of thousands of dollars. I got maybe 10 grand sitting in the bank. I've tried some wholesaling stuff. I've tried door knocking. I've tried mailers and stuff. Nothing seems to really crack it. Like, what would you do? And she turns to me and she says, well, I've never done it myself, but if I can go back in time, there's a product I would 100% use that would have given me the absolute best boost into the game. And it's called the FHA 203K loan. And it was the first time I had ever heard about the product. And we could talk more about why, and we kind of talked about it in our last conversation, but that's a whole interesting story in and of itself. But she said, and I said, okay, well, what's that? It's the first time I ever heard about it. And to what you said in the beginning of the show, it's an owner-occupant loan. So of course, it's like a house hacking model. It's a model where, like, you buy your own property. And at the time, I didn't have my own house yet, right? You buy your first home, and if as long as you live there, you only have to put 3.5% down, and you get all the money to renovate it as well. So you only have to put 3.5% of the purchase price plus the renovation. And what you could do, she said, and basically do the BRRRR strategy. She said, live in the basement. In New York, basements are very popular. Live in the basement, rent out the upstairs to cover the mortgage, and then renovate a fixer-upper or foreclosure and as-is property, renovate it, and build the equity into that property off of a very low down payment. Now, let's say you build 20% equity into the deal, you just turn your 3.5% into 20%. You just, 5, 10x your money. Then you live there, live it out. The requirement was for a year. She says, take it, repeat the process. It's basically doing like a house hacking BRRRR strategy. And
So real
that's
quickly for
exactly what I
everybody in
did.
the audience, sorry, Matt.
Yeah, no, of course.
BRRRR, we're using some acronyms here that maybe people aren't familiar with. So BRRRR is a renovation. It's a hybrid strategy where you buy the property like a fix and flipper might, right? But you don't sell it after the fact. You keep it as a rental. So buy, renovate, rent, refinance, repeat. BRRRR.
Exactly.
So you basically took like multiple strategies and baked it into this 203K. So you said you're living in the basement. So this wasn't a multifamily property. It was a single family.
So great question. So what ended up happening was I went out on the prowl, right? And
Yeah.
I took what she said, and again, by necessity, this was my only option. This was the only thing that up until now, with all my studying in real estate, that was the only thing that seemed that was attainable for me in that moment. Now, again, some people might be listening, and it's not exactly for everyone. People are like, hey, I live in my own house right now. I don't really have interest in moving somewhere else. It might not be for you. Now, there's renovation loan products out there that are similar that don't require owner occupancy, but they have a higher down payment. We could talk more about that. But at the end of the day, for me in my situation, this was the only option. So what ended up happening was I went out there and started placing offers. I got pre-approved for this and started placing offers on houses. And just like anything else, like, even back in 2016, 2017, when I was doing it, it was hard. Like, no one was accepting it. People were telling me, yeah, right, kid, you're not going to find a house on Long Island. Your budget's too low. And it wasn't until I was looking around and I saw this house that was literally a crack house. And it was really nasty. The pictures were brutal. It was kind of in a rougher part of this town. And but it was the only thing really in my price range. And it was kind of still not even in my price range. It was at the top of my budget. And I went in there and realized that it needed a full gut. And I was like, I went back to my lender and I'm like, you know what? I don't think we could do this, man. My lender's name was EJ. And he said, well, no, listen, one of the cool things about the FHA is that you can buy up to a 4-unit property. So FHA 203K, 203K is a version of the FHA loan. It's the same standards, same guidelines. So he said, you can buy he's like, this property happens to be a legal 2-family property. So now what you're able to do is you're able to forecast the future rental income of that other unit, which in New York, the good side of New York is you have high rents. So you have high costs, but you have high rents. And I was getting $2,000 a month for that other unit. That's what was forecasted at. So what they were able to do is forecast that on my debt to income ratio, which essentially just means that I was able to get approved for significantly more. So on average right now, for every $1,500 that you can make from other units in your property, if you're buying an owner occupant, multifamily property, for every $1,500, you get almost $100,000 bump in your buying power, which is crazy. And it's a really important thing right now for what the market's doing and the affordability that's happening all across the US right now, not just for house hackers, but for first-time home buyers, millennials, everything like that. And that's ultimately what gave me the option and gave me the ability to get that extra money I needed to buy the property. So what ended up happening was I was able to pick up the property for $270,000, and I had an $80,000 renovation budget on it. So I was all in for $350. I only had to put 3.5%, and it actually equated to a little less than 3.5% because I got a full seller's concession back, which again is another detail we could dive more into. Ultimately laid out $9,500. That's all I laid out for this property. Closing costs were covered, $9,500. It was a little less than 3.5%. And got to the closing table, closed on it. And what they do is when you close, they put that renovation budget in an escrow account. And then your contractor gets paid based on them, as they complete the work. And that's what we did. And we went through the renovation, fully renovated it out. There was some bumps and bruises along the way. It took me about 8 months to do the renovation, which was a lot. But at the end of the day, when we reappraised it, it reappraised for $480,000. So I had built $130,000 in equity in just 8 months. And to make matters even cooler was that I was only, to your point, I wasn't living in the basement on this one. I was just living in one of the units, briefly actually, because the limit is only 1 year. And I had also ironically just gotten engaged with my now wife. So I had, we finished that property and I had moved in with her to plan our wedding and everything like that. So very soon after, I made that a full income producing rental property, and it cash flows me to this day like over $2,000 a month. So all off of that $9,500, using government financing and leveraging it as an investor was really the jump start and the launching vehicle for me to get into the game. And that's ultimately what it did for me.
Oh yeah, it opened doors. It gave you options, which a lot of people didn't have. And it is great too that the FHA has that kind of hybrid account where you can take potential rental income and factor it into your income and get that DTI number to work. I can see a lot of people would see this and be like, oh, that 90 grand, that 80 grand, that's money in my pocket, right? Like they would want to go and take it and use it some other way, but they're very careful about making sure that that escrow account only pays out for specific things, right, to the project, just to protect it. Because we're all human, and human nature is to like take that and try to get over. So how does that work? How does the drop process work?
Excellent question. So essentially, when the best, so this isn't how a lot of people out there do these the wrong way. And that's ultimately why I created the 203K way, because I did it myself, helped a lot of other people do it, and realized why it's real estate's secret and best kept secret out there is because a lot of lenders and real estate agents, sometimes they know about it, but they don't do it the right way. But here is the right way to do it. And here's how it ties into your question. So when you get a property under contract, okay, the difference between this and just a regular loan is that you're going to be doing a renovation on the property. And we need to make, if the bank's going to lend on it, they want to make sure that you're doing the correct renovations to the property. So what happens? They bring out someone called a 203K consultant. Now, a 203K consultant, 9 times out of 10, is usually just a local home inspector that also has this certification part of their arsenal, right? So a lot of them out there already probably have it. It's just another thing that they have. And basically what they do is they go in, they inspect the property, they see, obviously what needs to be done from a safety perspective and everything like that. Then what they do is they ask you, okay, all right, Benson, what do you want to do to the property? What would you like to do? Do you want to renovate the kitchens and baths? Do you want to, want to change the floors? You want to add a dormer? Contrary to popular belief, like the FHA, the 203K, like is really open to what you can do. I mean, as long as it's integral to the house, you can dormer. It could be an existing foundation in the ground that there just has to be something there. It can't be a new build. That's the only rule. But if there's something there, you could build on it, put whatever on it, as long as it meets code, as long as it meets the right requirements and safety requirements and everything like that. So that's what they do. And that consultant will work with you to build out what they call an SOR, which is essentially a line item scope of work, which my background's in construction. And one of the things that people always talk about is like contractor horror stories and everything like that. What the 203K and one of the biggest complaints that we see from real estate agents and lenders alike on this loan product is they always say, oh, it's too much paperwork. You don't want to deal with it. Let me tell you what the paperwork is. The paperwork is a line item scope of work and the licenses and insurances from the contractor. That's all the extra documentation that happens. A couple affidavits, literally with DocuSign now, it takes all of 5 minutes to fill out. This is how I worked large scale construction in New York City for 15 years. This is literally how construction is supposed to go. You have a scope of work created, it's line itemed, it's detailed so that there's no loss in translation. And you make sure that they're licensed and insured, because that's not a good thing. Like, don't think you're going to save money using the unlicensed guy. So that's what they do. And what they do is when they have that scope of work, then the contractor looks at that scope of work, gives their bid based on that scope of work. Again, this is how large scale construction works. They call it leveling the bid. So what you do is you shop it out to multiple contractors. They come back with their numbers. You pick the guy or gal that you want to use. And then what happens is they go to closing and that money goes to escrow. Now, that 203K consultant still is a part of the journey. What happens is they close and the money goes into the account. I can't just go to that account and pull out, the 50 grand, like kind of like you were talking about, right? You have to go and submit draws. So similar to hard money, if anyone's familiar with hard money is like institutional lending on asset based, right? Hard money works the exact same way. They give you all the money to purchase plus all the money to renovate. Obviously not as much as they do on the 203K. Hard money requires a lot more money down payment. But at the end of the day, it works the same as the contractor completes the job, they get paid out on the work. Now, they'll give them some startup capital. It's another concern that people have. Contractors like, oh, you're going to finance the job. This is guaranteed money, and it gets released to the contractor very quickly. It could be wired to their account. They'll give you some startup capital as a deposit to get them rolling. But yeah, ultimately, that 203K consultant goes out, looks at the they're basically like the referee of a renovation process, because it's really good. How often do you have like homeowners and homeowners and contractors going back and forth on like, well, I don't deserve to pay you for this, and well, you need to pay me for this because I finished it. You have a neutral third party that goes in there. They're really interested for everybody. They're there for you. They're there for the contractor. They're there for the bank. And they look at what work gets done and they say, hey, listen, you finished half of the bathroom. Okay, so we're going to pay you on half of the bathroom. You did all the floors. We're going to pay you 100% out on the floors. You're still missing something, so we'll give you 80% of that line item. So that's how it gets drawn out, and that's every time they come out. And usually they come out like, anywhere from 3 to 4 times, depending on the size of the reno.
And some people might see that as a hindrance, but it's just like having somebody else on the team who can help you along, a consultant who's there to help you through the process, because there's a lot of moving parts, especially for someone who's never done it before. That first time, they're kind of learning as they go. So having that consultant / referee there to kind of guide you is just a huge asset to get you through the process so you don't make mistakes, because that's where a lot of people mess up with like a normal fix and flip. They've never done it before.
Exactly.
So they go in there, they're trying to figure it out as they go. And we've all heard the one and done story of people who tried, lost money, never did it again.
Yeah.
So this is a great way of like starting that process, learning how to work with contractors, how to have those discussions, how to work through a budget and line items and meeting deadlines and all of the stuff that has to fit to make it FHA compliant. It's just a great way of starting with very little risk. in a
Extremely
renovation
low
project.
risk. Yeah, it's like flipping a house with training wheels on. Like I always say, like you're to your point, like you have. Now listen, at the end of the day, there's good and bad of everything, right? There's bad consultants out there. There's good consultants out there. So at the, everything comes down to like having a good process from the very beginning. But to your point, like these things are there to help you. They're not to hurt you. And for someone that's looking outside, looking in, like the loan was built assuming you have no idea how a construction project is run,
Right.
right? So from the outside looking in, someone looks at it and they see extra paperwork. Oh, I need to get the contractor to fill out this form and this form and this form. If I just did it myself, I wouldn't have to do that. Well, the reason they make them fill out all this stuff is because your average homeowner is not doing all this stuff.
Mm-hmm.
And what is the general consensus on contractors out in the world? When you ask
Over
people, what do you
budget,
think of
over on
contractors?
time.
Right. Like contractors suck. They're a pain in the butt. They walk out, they steal my money. You can't contact them. They're doing this stuff to help you. It's not there as a hindrance, like you said. And with the consultant, yeah, it doesn't really slow up the job. Again, like anything else, they're there to check and balance and to make sure that things are going well. And the bank's happy that they're getting, that the money's that the repairs are going well. You're happy that the repairs are going well. The contractor's also happy that they're getting paid on the work they actually did. And someone else
Mm-hmm.
can tell them, I always tell them, people, like, remember, like the 203K consultant's on the side of the contractor too. Like if the homeowner's being a little crazy and being like, well, I don't want to pay him, but like, hey, I know you don't want to pay him, but it's black and white. They installed the floors. Everything's good. They might be scratched or something, and you guys can figure that out back later. But like, they're installed. Let's pay them for what they're worth. So yeah, it's there to help you.
Yeah, flipping a house with training wheels.
Yeah.
Really, really good way of describing it. And I like the idea too that this is a loan that you can get through the government, right? So like a lot of those hard money loans that people get, they're high interest. You're talking about 12 to 15%. You're gonna have to pay upfront points. That's just like kind of like origination fees, for the lender to get
Yeah.
some money up front.
Mm-hmm.
So this FHA loan, like these are the lowest rates that are available to anybody to get a loan, the least
Yep.
amount of money down. So there's no downside to it, except for some people might view that the occupancy piece of it is the major downside, but it's only a year.
Yeah.
Which I mean,
And it's
it,
it's a
it might take 6
downside.
months to do the project anyway.
Right. Well, literally that. And that's what a lot of people, it's a year from the closing date. And, listen, right? Like I said, it's not for everybody. But at the same time, if you are willing to make that, everything's a push and pull. Everything's a sacrifice. People say well, I can just use hard money and I don't have to live there. Okay. Do you have 30% to put down? Especially if you're
Right.
starting out, right? Like we're talking about people just getting into the game, right? If you're a well-established investor and you got money, you got private money private money sources and everything like that, this isn't your game. It could, I'm a big believer in, if you're occupying the property, you should always use renovation financing. Why would you use your own money when you could finance it over 30 years with a federally backed mortgage? Like, why not? It's free money. Or as
Mhm.
close to free as we could possibly get. So why not use the leverage as long as you're smart about it? But the occupancy thing, and like you said, it's a way, like if you're patient, you could do it over and over again. Now FHA, and here's some cool stuff that has happened recently. So if you asked me a year ago, could you repeat this loan? That's like probably the number one question I get when people come in. So they're like, all right, Matt, you know what? I'm going to do this. I'm going to live out the owner occupancy requirement, but how soon can I redo it and how often can I do it? Because you think about this and you think about it like, well, let's just use it as a flipping loan. 3.5% every time. Well, why am I going to flip that? Why am I going to flip with hard money if I could flip with this? At the end of the day, it's not built for flipping, right? It's built for owner occupancy. So you're not gaming the system, but you're working with, you're molding it within the confines of something, and the guidelines work. But you're only allowed to have one FHA loan under your name at any given time. Okay. So you have to refinance out, and you have to build enough equity to refinance out into conventional, right? It has to make sense financially. And that's what I always preached. And that's what I did, right? I did mine after the 8 months. I refinanced out because I built 25% of equity. So I refied out, I went into conventional, and I didn't really have to worry about the FHA anymore, so to speak. Now, the beauty of the FHA loan for years is that it's the product that allows you to buy up to 4 units for only 3.5% down. So it caters very big to the house hacking community. Buy a property, live in one unit, rent out the others, build your portfolio very quickly with very little out of pocket, right? And people say that's a great way to get started and that's a cool way to do it. But then you're stuck to just the one. In November of last year, Fannie Mae, who's basically the conventional loan product, that's also, federally subsidized and backed in some way, shape, or form, they were having trouble, like a lot of banks in America, having trouble endorsing loans. A lot of the inventory was drying up, rates were spiking, affordability was going down. So what they do? Fannie Mae, at the end of the day, is a business and they do need to make money. So they opened up the guidelines quite a bit. And one of the big kickers that they did was they now allow you to, because FHA was the only one. Fannie Mae allowed you to buy up to a 4-unit property, but if you went to 4 units, they would bump up your down payment requirement to 25%. In November of last year, they dropped it to 5%. So now you only have to put 5% down to buy a 4-unit property. Now, what's cooler with Fannie Mae, and for the house hacking people or even people that want to do this, is that you can have 11 Fannie Mae mortgages under your name at any given time. So if you really want to, and I advise it for the people that have the freedom to do so, you can do this year after year, year over year, and build a portfolio very quickly of only 5%, buying quadplexes, triplexes, whatever, moving into it each time, and build your portfolio extremely quickly with very little out of pocket, and do it all within the confines of what Fannie Mae is allowing right now. And Fannie Mae has a home style loan, which is the exact same thing as the 203K. I say 203K. The 203K is the colloquial term for renovation financing. Really what I teach is these renovation financing loans. There's a couple of them out there. The 203K, the home style, the choice reno. There's other couple, like some off-brand ones. But at the end of the day, really, they're all exactly the same and pretty much operate the same in the sense that they give you all the money for upfront to purchase, plus all the money to put down, and they usually only require a small down payment. So what you can do is you do the home style version, and you just do that as well. And it's follows the same process. They give you all the money for the renovation. It's actually somewhat a little easier and more lax in like the scope of work creation part. They don't need a lot of rigidity in the way the scope of work works. But, that's a huge option now. And it's really, really changed the game for the house hacking community and really just any beginner investor community, because you could basically live and flip your way to an amazing portfolio with very little out of pocket and completely change your trajectory in your life if you just sacrifice a couple of years.
Oh yeah, and I don't even say it as sacrificing, really. Like,
Yeah, you still need a place to live.
You do, right? So why go and have a whole house which you're just paying one mortgage, you're not making any money off of it. Like, this is just an amazing thing. So the only difference is that there's an extra 2% or 1.5% you have to put down with a 5% down payment instead of 3.5%.
Yeah, what's actually,
right?
and I could obviously, as you could tell, I can talk about this for probably ages,
Yeah.
and there's so many nuances and things. But one other little thing about it is, so FHA has something what we call mortgage insurance premium, or upfront mortgage insurance. Basically, for anyone listening, mortgage insurance is what you pay to FHA as your basically fee for being a subprime borrower, right? Subprime meaning you're putting less than 20% down. So what they do is they hit you with a fee. That's basically your insurance payment. I mean, it's literally exactly what it is. And that's what gives the government the ability to insure all these mortgages to these banks. Because the bank is not, the government isn't really giving you the mortgage. They're giving you the guidelines and they're supporting it on the back end. The bank's giving you the mortgage. So the bank needs to be incentivized to do it. And mortgage insurance is the way it works. There's a lot of people explain say what a mortgage insurance is, but don't really explain why. So that's why you're paying it. So it makes sense as to why you're doing it. FHA is a little bit higher on the mortgage insurance side. They just dropped it. It's 0.55% of your total loan amount year over year. But what they also have, which is a big difference between the Fannie Mae program and the FHA program, the FHA requires I think it's one. I always get this confused. It's either 1.5% or 1.8% of upfront mortgage insurance. Now that gets wrapped into the loan and you don't see it. It's a closing cost you can pay out of pocket if you choose to. It is a
Mhm.
closing cost, but it can get wrapped into, it's a wrappable closing cost. So I tell people it nets the same at the end of the day because the Fannie Mae does not have that. So the FHA is 3.5 plus 1.5. And then the
Mm.
Fannie Mae is a 5. So no matter what way you cut it, again, maybe the only difference is that you can wrap it. So like, I guess if they don't see it, they don't think it's real. But at the
Right.
end of the day, you are paying that money.
Yeah, it gets paid for in the
Yeah.
purchase price of the property. Are the rates different on the Fannie Mae program? Is it slightly higher?
Great
Seems like it
question. So I
might
was
be.
just talking about it with an agent earlier today because she's looking to, another thing too is obviously we've talked about this with investors, but like this is also a big thing for retail, especially right now. Appraisals not hitting, inspections not passing. The deal does not have to die. You flip it to one of these renovation loans, you can get it over the finish line. Appraisals based on after renovated value. The 203K allows you 110% of the after renovated estimated value. So if you're renovating the property, if you're buying a property for 300,000 and you're putting $100,000 into it, it's worth 400,000 when you're done. You can actually get a loan out for 440,000, even though it's going to be worth 400 when you're done.
Mm.
So I don't advise that. Obviously, I tell people to force equity and make money on it. I don't want you to go underwater. But for retail buy, remember, this is their owner. For a lot of people, this is their forever home, maybe. And they
Right.
don't care if they're over leveraging a little bit because they're using money to make it their own so that they can stay there for a long time. Um, but to answer your question with the rates and stuff, so this is where a lot of people go wrong. Like the lenders and the agents, or the lenders specifically, you have three things that happens with lenders. You can ask them about the 203K, and one of three things is going to happen. Number one, they're going to tell you, don't do it. They're too much of a pain in the butt. It's not, it's not worth it, which is another way of them saying, I don't do these and I have no desire to do them.
Right.
So they don't want to lose your business. They work on commission. So they're going to naturally just downplay it and say it's bad, because if they said it's good, you're going to go find it somewhere else. So that's the first thing that happens. Second thing that happens is they'll tell you they do them, but they have no business and they don't really understand how to do them. The third is they know how to do them and they are experienced, but that's in the 1%. That isn't the norm. So the reality of it is that for the ones that fall in that second column, ones that'll do it, is some banks, they'll just beat you up on points on the back end. Now there is no guideline or anything that says it needs to be higher than FHA. It should be, and it can be, it's the same points, the same rate up front. Now banks out there will put overlays on it. So always look and check if they're putting a lot, higher origination points than what you're seeing in other places. If they're putting higher, giving you a higher interest rate, it shouldn't be. And the banks that do these often don't put them on. If you see something, it might be a quarter point, a half point, something here or there, just because it is a little bit of more of an involved loan, which is totally fair. But there's some
Mhm.
banks out there that really beat people over the head with it. And that's a big red flag.
Yeah.
Again, and it's usually a sign that they don't do these often.
But either way, if you were to go and do a non-occupant loan with 20% down, you're going to have a higher rate
Yeah,
that
it's
way
not even
too,
close.
right?
You're
So
talking
it's
like, yeah.
what is the difference, do you think, from like a non-occupied, rental loan
Mhm.
compared to, say, the Fannie Mae rate? A couple
I mean,
points?
yeah, I mean Fannie Mae. Well, so FHA is the lowest interest rate on the public market, right? So
Mhm.
so when you look at your mortgage, when you go and look at mortgage rates today, FHA is always the lowest, significantly. It's just because it's a government backed program. So if you're using that, there's that. Obviously, conventional is going to follow conventional 30-year rates. But they're when you compare, to like investor rates or anything like that, they jump you up 2 points, 3 points, plus a lot more origination,
Mhm.
and again, a lot more down payment, which is really at the end of the day, that's really what we're looking at with a lot of people, is just the equity, the upfront equity you need to bring to the table. This is something where you don't bring any equity. It's low risk, but you get to see all the upside, and you get to
Mhm.
take all of that upside. So yeah, I mean, with DSCR loans and stuff like that, you're seeing significantly higher, and it's experience level too. I always love to tell people, you know, it's one thing if you can find lenders out there that will gift you. And again, like when I was flipping and everything, I was able to get my hard money lenders to get me to only put down like 10%, 15% on some deals, but it's also asset based. So it's got to be a good deal that's coming in. And they also know that I've done a bunch of deals with them before. So they know I'm good for it. If you're new, it's really hard to establish those relationships. And even if you do, you better make good on them. And there's a lot of stress with that. Like you said before, like we keep saying, like this is so low risk. You're using government-backed capital that's very, very low out of pocket, very low risk, and just very high upside. I like to tell people all the time, right? The average, you probably know the stat, but the average appreciation rate of housing in America over the last 50 years, I think it's on average appreciated about 3 to 4% per year, right? So 3 to 4%. What's in there? 3.5. So 3.5 is your down payment. If you hold that house for a year, if you follow generic appreciation rate, you made your money back in that first year. You made your money back. You doubled your money effectively in the first year. Or again, you made it, and then the second year you doubled it. And the third year you tripled it. So, and that's not counting all the other extra added bonus of you forcing appreciation from the renovation, stuff like that. House hacking, you're also getting money from the other tenants, stuff like
Oh
that.
yeah. Well, and it's compounding
Oh yeah.
appreciation too, right? Because if it appraises, if you bought it for 100 grand and you only put $3,500 down, but now the house after you do the renovation is worth 200 grand, well, it appreciates 3% that year. That's 6%,
Yeah.
right?
Of your original
Or,
three.
or that's
Yeah.
$6,000, right? Instead. So it's like every year it goes up. It's 3.5, 4% of what the current value is.
Yep.
So it's just compounding. So it's not even like a 1-to-1 ratio. So that's way better than people would even think.
I talked about that on a recent webinar I did because what you get stuck on and what we get stuck on in this day and age is instant gratification, right? We are
Mhm.
living in a super instant gratification world. And you know, I always get caught up in telling people instant equity and stuff like that. And that's all well and good and true. But and what's funny too, and I'm really excited to share this because I think for anyone that's listening that's just starting out, like this is so important. I wish people told me this earlier, and you'll probably appreciate this. I got into it looking really for cash flow and really just for like again those instant hits. Instant. I
Mhm.
was in the flipping business, so I flipped. That's what
Yeah.
I after I did this first deal, I took that money and started flipping. Do you bet I regretted it? I sure did, because I look at those properties and I look at what they're worth now, and I know that I would have been sitting on a lot more equity. I would be a multi-millionaire right now because, but I sold them because I was interested in the quick hits. But one of the things I have started to realize is where real estate really shines is just letting it do its thing over time. And I'm
Yeah.
getting to that point where I've owned some properties going on, it'll be, almost a decade. And I'm like, man, it's nice when you start to really see that compound appreciation like you were talking about. And
Mhm.
you start to see that principal pay down happening with some of those loans. You're actually starting to dent the principal a little bit. And you're like, man, okay, this is really like the cash flow is cool, but the cash flow doesn't really change that much. Like you're riding that equity rate wave. Now I'm more bankable. Banks want to work with me. They see I'm a high net worth individual. I have $1 million in assets, $2 million in assets. Like they're willing to give me more money, right? I think Einstein had the quote something about like compound interest is the eighth they sell like the seven
Eighth wonder
seven
of the
wonders of
world.
yeah. It really is. And
Yeah.
it's so hard to convince that to people that are just in the game. So if you're listening to this and you haven't started, I feel like I never want to sound like the old guy, like just wait, kiddo, because I was the kid that didn't want to wait at all. I still am that person. But like, man, when you look at that 3.5% down over a 20-year time domain, and I just did this on the webinar, like I was saying before, you look at that 3.5% down on a 20-year time domain, it is mind-boggling
Oh
how
yeah.
much money you are making off of that 3.5%.
It's insane. It absolutely is. And so there's some moving parts here, even with the consultant. Like there's some things that people still have to figure out. And that's why you created this program, is because now you can guide them through the process, through like a systematic way of, educating them. Like, this is how you do the 3OK way, the right way. Not because there's still places where you could mess up, right? So you
Oh yeah.
probably have a network of, lenders that know how to do this, or they've done it 1,000 times. So they're gonna make sure everything's buttoned up. And I'm not sure if you can choose your consultant, but you probably know consultants, and you likely know agents that understand this process,
Can never
right?
know
So
enough
like,
of them. If you're an agent listening, reach out because this is important. Yeah.
yeah. So that's part of what you've created, right? So your program creates additional guidance and guardrails along the way to make sure that they're coming at it on the back end without, being beaten up.
Yeah, I make the analogy. This was a new one I tried recently, so let me know if this hits or not. But because I try to think of it in terms of analogies, because the 203K is a nuanced thing, and I try to get people to realize it. And what people say is like, why is it the best kept secret? Why do people not talk about it? Why do agents throw rocks at it? Why is it so taboo? And I ruminate over this question all the time. As you can imagine, I'm so obsessed with this. And the reason being is that agents and lenders, who are really the only people in the world that can really talk about this, besides me, the guy that has a social media platform, because this isn't new. This has been around for a long time, but it was in the only people that were in charge of getting it out there were lenders and agents. Now, lenders and agents look at this and it's extra work for them. And at the end of the day, even though it might be the borrower's best option, if it means that it's going to stand in the way of them getting their commission, they're not going to want you to do it. I understand that. I'm not saying they're bad people for not letting them do that. And I'm not saying they should be held accountable for that. Where I'm trying to come in is just educate people on it, because if the more education out there on it, the better. And that's what it is no one was just properly educated on it. And once that happens, that becomes a real thing. So my analogy that I was getting to is that everyone's gate kept it because here's what happens. You do, you want to do a 203K. You get your lender. The lender sees this side of the 203K, right? I relate it to Mario. You played Mario, right? And you know how Mario has different worlds. You start and it's like the rainbows and the flowers, right? And then the next world is like, the desert world. And then the next world's the water world. And the next world's the fire world, right? And they're all different worlds. Now you have all these people that are in your team, your real estate agent, the 203K consultant, the contractor, the lender. They're all different people working at different stages in the game. So the lender, the real estate agent only sees the rainbow and butterfly world, and they never see what's beyond it. Then the lender only sees the desert world. The contractor only sees the fire world, right? The 203K consultant will see a good amount of it, but they're not an active component in it. To your point, like, do you pick them or not? You can pick them, but usually a good lender is going to give one to you because they work with them often. Where I've been able to crack it is I've beat the game hundreds of times. I know every level. I know exactly how every level is. And I beat it so many times that I know the shortcuts. I know if you remember, you go down one pipe and the cheat codes. I know it because I have beat the game over and over and over again. And I've seen the very beginning of the game, and I beat Bowser 1,000 times. I've seen the complete end game. So the stuff where if you're just used to playing the fire level, when it comes to the desert level, you're not gonna know that there's like that sluggy guy that's the prickly guy, and you have to like hit him a certain way to get him to die. Like, you're not gonna know those different aspects of it, and I don't expect you to, and you don't have to. But the problem is like, people need to understand that like this is all part of the bigger picture. And what I do in my system, and kind of what you talked about, is like, I know how this looks like holistically. Again, I'm an engineer by trade, so this is the way I think. I reverse engineer it. Where do we want to go? Okay, this is where we want to go. We want to build 6 figures of equity. We want to live for free. Awesome. What is it going to take to get there? And you go back and you see like what the deal needs to look like, what needs to be penciling out, what these things go, the type of loan you need, the type of financing you need, the area you need to look in, and dial it all the way back. Now we have a plan of action. And when people ask me in the beginning why I'm telling them to do something a certain way, or why I'm telling them to get multiple bids, or why I'm telling them to do this, it's because I know what happens down the line. I know we're trying to set you up in the beginning, because because me telling you to do this now with your contractor is going to make a world of difference when you're getting to that point. And it doesn't sound right in the moment, but later on, I'm like, hey, you remember why we use, I went hiking last week, and it's like, you should have packed the sunscreen. I forget. I'm not always in Arizona. I was in Arizona hiking. I forgot. I'm not in Arizona every day. I should have had sunscreen. Now a person that hikes in Arizona all the time would have told me, hey, Matt, you should have brought that sunscreen. Hey, man, make sure to pack some sunscreen, right? Because they know how nasty that sun is. And so it's stuff like that. I'm just telling people to pack their sunscreen early at the end of the day.
Yeah, and this is a long-term strategy too, right? So it isn't just getting this first deal done, it's thinking a couple steps ahead and
100%.
saying, okay, well, listen, we got to think about the next project, right? So you're going to be there for a year, maybe, toward the end of that 8 months or, 10 month scenario, you get with Susie Realtor and you guys start looking again, right? So to find your next project. And,
Oh, yeah.
the first time you did a 2 unit. So let's look for a 4 unit this time, really, so we can really start getting that cash flow and start looking at like this as a investment strategy, not just, let's get one deal done, right? So you're thinking down the road as well.
I always tell people like the 203, like when I work with personal clients and people in my community, I tell them like, listen, like this is the finishing that deal. We're not done. You just opened the door. Like you're just getting it. You're now in the game. Now it gets fun. Now you plugged in. So like it's just the beginning. And I love that you said like this opens doors for you. And that for me was the biggest epiphany with real estate investing in general, and me trying for so hard for so long and being really frustrated that like, and if you're listening to this and you haven't done a deal yet, like you need to burn the bridges and do whatever it takes to get that first deal done. Again, if it's not the 203K way, whatever it is, like again, for me, this is what gave me the entry card. Because once you enter that building, the doors, you're standing outside, you don't know what doors are inside. But once you get inside, the amount of doors is mind-blowing, and the amount of ways you can take the direction, and getting that key card and getting that experience and getting that capital and being able to like sit there and also most importantly, just having the confidence, be like, hey, I did it once. I'm a little more confident now. I'm not super confident. I'm not going to be arrogant about it. I did it. It is possible. So now that belief factor is just going to completely change your way of doing things. And like, I remember one of my mentors telling me like you should be raising private capital, and me like just being like, what? Like no one would want to work with me. I've only done one deal. He's like, you've done one more deal than 99% of the population that dreams about doing a deal.
Right.
And that sometimes is just enough for people to believe in you. And they did. And my second deal, I still used my own money because I didn't believe them. But after that, I was like, I did 2 deals. People were coming out of the woodwork. Like, hey, people I didn't even know had money. Hey, I saw you flip houses. Like, I got some money laying around. Do you want to partner? I'm like, I didn't even know you had money. But the
Your own
door,
friends and family, right?
the door would never open if I never did that first one.
Yeah.
And I tell people like you don't need a lot to start, but you need a little, and you need to get it done, because once that's done, like it changes so much. I always say like the first deal won't change your life, but it will change your life. Like it's not going to change your life in the sense that like you're going to do a real estate deal and you're going to be sipping Mai Tais on Miami Beach. Like, but it will change your life, and you're going to be like, oh my God, like I just traded value for money instead of time for money. I just started to see the true benefit of real estate. I'm seeing a whole world that I didn't know. Again, for me being the blue collar, like again, reading Rich Dad Poor Dad, being like, oh, this is how people get rich. And you're like, when I did my first accounting thing that year, and I was like, wait, even though it's my own property, I could still write off, like I could still write, even it's under my name, I could still write off stuff. She said, yeah, you can still write stuff off. It doesn't need to be under an LLC. It's a common misconception people have. Like I could still write off stuff. And she's like, you depreciate the asset. I'm like, wait, so I don't have to pay taxes on the rent I brought in? She said, well, I mean, you're paying it in depreciation, but like, no, you don't owe anything for it.
Right.
It's like, whoa, okay, this is cool. So it's really exciting when you get that first one.
Oh yeah. You know what I think one of the biggest things that for anybody who's listening is if you're a real estate agent and you're trying to figure out how to differentiate yourself from all the other agents that are out there, um, the investment world is a way to do it, but this is even more of a way to do it because
Oh
with the
yeah.
NAR lawsuit, and you're an agent, you have to earn that 2% if you're working with buyers. So if you learn this process, you're bringing massive value to that buyer, and they will happily pay you that commission that you're trying to figure out a way to earn right now. Wouldn't that be a great angle for agents to really start showing like this is how I bring value to the table?
Benson, if I could take that and clip that and put it from the mountaintops for the end of eternity for agents, I would. You nailed it. You absolutely nailed it. And I work with an agent locally. This guy, he calls himself Pocket Pete. Everyone in New York and Long Island has a nickname. It's very funny. It's like such a Long Island New Yorker type thing.
I
It's like,
love it.
old mafia, like every mafia guy had, Paulie Walnuts and you know, anyway, so he had a great quote and or not a great take on something like, like I'm sure like a lot of agents out there, he gets Zillow leads, right? He buys them. And on his first conversation, actually within the first minute, he mentions the 203K loan. Just mentions it. What does that do? These people are shopping around, they're looking for an agent. They all are saying the same song and dance. They're all just people like, oh, yeah, we're going to help you and blah, 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 and this, that. He said, yeah, no, we have a lot of different options for you. We want to look, really see what you're looking to do. Depending on your situation, there's a lot of great options. Like, we can use something like a 203K loan that's going to allow you to purchase a property plus get all the money for the renovation. We can house hack. We could do some of these different things. Or if you're just looking for move-in ready, we could do for that with you too. But I just want you to let you know we're full service. So whatever you throw at us, we're going to have a tool for it. You tell that to someone that has just been getting the same spiel from every single agent. Now, they probably don't even know what the 203K is, and that just piqued their interest. Like, wait, there's a thing I can do. Now, here's the thing. 95% of the people that he ends up working with don't do a 203K, but he just brought something to the table that showed that he's different. He has all the tools in his tool belt. He's the guy. He's going to get you whatever you want and whatever you're looking for because he's got every tool to get you there. And that alone goes a long way. And I hope Pete doesn't mind me sharing this. I know he doesn't. He's a great human. But like if you're an agent, you're listening to this, just saying it, that it exists. And you don't even have to fully understand it. If you need help with it, message me. I will help you with it. But you could be the unsung hero in all of this and just presenting something to your client that gives them such an out or such another opportunity that they thought up until that conversation that, oh, well, babe, we got 20% down, but outside of that, we're strapped. That's it. So like we're looking in an area, we really like this house, but like the kitchen is disgusting, but I guess we're just going to have to deal with it for the next 10 years until we can save up for the renovation. No, you can get it and get the kitchen that you want, and your monthly payment's barely going to change. And it's the conversation. I tell agents all the time, it's not the conversation they're having with you. It's the conversation they're having in their head. It's the conversation they're not having with you. And I can guarantee in this super tight market that we're seeing right now, in this super expensive market, these first time home buyers are so frustrated, and they're thinking about their liquid capital. They don't want to they'll tell you that maybe they have money in the bank to afford the renovation, but they weren't intending on it. That money was supposed to be for their vacation or their kids or their retirement or something like that. It's there, but they don't want to access it. And you're telling them to do it, and they're like, all right, babe, maybe we have to. What if you could tell them, hey, listen, we could still do what you want and you don't have to tap that? That's a hugely powerful thing.
Oh yeah, absolutely. Things are changing so quickly, and for the agents that are out there, like definitely hook up with Matt, to learn this strategy on how you can leverage it in your business and start to, differentiate yourself from the competition that's out there and really just create value. Because with the commission thing now, like you're gonna have to earn it. And so, a lot of agents are leaving the business because they don't even want to put the work in to try to figure out how to be different. They're like, it's not worth it. And they're leaving, right? So there's
And
gonna
a
be
lot of the good
more for the
agents out
people
there
who
should
stay
be,
there.
yeah, and the good agents should be saying good, like
Yeah.
good, like leave, right? Like we don't like you could appreciate this, right? Like being an agent, you have I'm not an agent, I'm not a lender, but I took the test to be an agent. I passed it. I did all the things. I saw everything that's in there. It says over and over and over again. What's the word it keeps saying? Fiduciary.
Mm.
Fiduciary means you are an extension of your client. You and your client are supposed to have the same wants, needs, desires. You're supposed to fight for your client's best interest, even if it's not your best interest. Does that actually happen? No. And in a lot of cases. And I understand that. I'm not saying you're human. Like, you're a real estate agent. You got a family. You have people to feed. Like, you want to get your commission check, and you deserve doing that too. But the idea of like, hey, we're gonna feed you half the commission, and all you're gonna do is fill out an offer and open a door. You got to bring more to the table, and people are depending on you to bring more to the table. They're depending that you are the expert, that you are exhausting all options. You're the expert. I tell that to people all the time. I am a big believer in paying people that have expertise in something. I do not want to pretend that I know what I'm doing in any way, shape, or form. I want to find the best person that does the best thing. And I'm renovating my own house right now. I'm using a Fannie Mae home style on my own home right now. I practice what I preach. If you want to follow me on Instagram, you can follow me through the process. And the siding guy is like asking me this and whatever. I'm like, listen, man, you're the expert. What would you do? And he's like, yeah, I do this all the time, and this is what I like. Good. I want to do what you do because you see this every day. You know what you're talking about. And that's how you have to be for your clients.
I love it. That's great advice. So for anybody that's out there that wants to learn about this, how can they find you? Where can they connect with you? Is there a website, or, what's your social media so they can check it out?
Yeah. My social media is my Instagram is how this all started. It was really just like I was active on Bigger Pockets and Facebook groups and all kinds of stuff, and 203K pops up here and there, and people ask about it. And again, there's not much information about it. And I was always the guy like screaming from the mountaintops, like, here's what you do, blah blah blah, and like even worse was like there's bad actors in there like that are like spewing misinformation about it, like just blatantly inaccurate stuff. So I remember I was when me and my wife were still living in our apartment in the city, like I asked my wife, I'm like, we're like sitting on the couch watching TV or something. And I'm like answering another message from someone on Bigger Pockets or whatever. And I'm like, hey, do you think if I like made an Instagram account about 203Ks that people would follow it? And she's like, no, probably not, but do it anyway. And I did, and I created the 203K way, and I call it the 203K way because that was my way. The 203K was the way I got into my real estate journey. It was the vehicle. It was the thing that got me there. So Instagram is my main source. I post all the time. I post every day. I've been posting every day for years. That's the best place to find me. Have a couple other resources. I have a Facebook group, the 203K way. You could look me up there. We have a group, a community just there literally to help. My whole premise of all of this is that I just want to be the help that was not there for me when I did this, because we kind of glazed over that part, and that's fine. We don't have to go into it, but like my first one was not all hunky dory. Like,
Yeah.
don't think that like I'm an expert at this because I've seen the good, bad, and the ugly. I've seen on my first one, I've seen some horrible. We're doing it on our own home right now. Like I said, with the home style, we got, a $250,000 renovation all in. We're building about 500 grand in equity, and we closed in 38 days. I know what I'm doing now. So I've seen the good. I've seen how it could look like when it's textbook. I could see how it looks like when everything's a mess. The Facebook group's there for that as well. And then I do free trainings and all kinds of stuff there. 203ksecrets.com/register. I usually do webinars. And then last but not least, if you're looking for a lender for this, as you mentioned earlier, I am connected with lenders across the country. We serve all 50 states. It took me a long time to do this because a lot of lenders out there, even ones that I've worked with in the past, most of them are good, but some of them still claim to be renovation lending specialists, still drop the ball.
Right.
So it's been a work in progress, but there's a group that has been tremendous. I can't speak highly of them enough. They are absolute savages with this product. So the 203kway.com/lender. If you're looking for a lender that's willing to do these and can do these in your market, you just fill out a quick little form there, and we'll put you in contact with someone that knows these. Because that's, if I could give one piece of advice for all of this, whether you follow my strategy or anything else, just work with a lender that knows what they're doing. That's going to get you a good amount of way there. If you don't, then it's a wild ride.
So, and that's why wouldn't anybody work with somebody who they know knows how to do this. So
Yeah.
it's just good advice. Well, Matt, thank you so much for taking the time. I really love this strategy. I think it's a great way for anybody to get into the business, right? Most people who are starting in real estate investing will, they think they have to do like wholesale, right? Like you did, to get some momentum, to get some liquidity, to create some cash, to get that first deal done. But I think this is a really good way of also starting. And a lot of people who start off in wholesale, their end goal is to own a property. So
Yeah.
this way, you're starting off with owning a property, right? And you're getting the
Yeah.
government to help you do it. And you got all these consultants, and you've got a great community and course where people can get additional help. I just think it's a really cool thing you're doing.
I appreciate that. And I think to your point is like, and I know you have a lot of people obviously in the wholesaling world and in deal finding world. That's what you guys specialize in. And man, when you combine, this is what I did when I talked about, the house we're doing right now, $500,000 equity. I found my property off
Mm,
market and combined it with a renovation loan. Ooh,
nice.
man, is that the magic touch? When you can find an off-market property for low competition, get something locked out at a nice discount, and then use a very low risk, very low interest, very low out of pocket loan product with that, and set it up for yourself. It is the home. It's a grand slam. It's not a
Right.
home run. It's literally a grand slam. So I'm a big believer, and obviously what you do and an off market, I think is just a tool that every person investor. I mean, I'm getting to the point, and we've talked about this. Like, I want like first time home buyers, and nothing against the agents. I'm not saying this to cannibalize it, but like, man, I think there's so much value in just being able to source your own product in whatever it is you do, whether you're sourcing, coffee beans or you're sourcing leads for properties. Like being able to be the lord of your own destiny and being able to control your own destiny is so huge. So what you guys have is tremendous, and combining these things is really awesome, and
Oh, yeah.
really profitable for people.
I love it. Awesome, Matt. Well, thanks again for sharing all of that background, and congratulations on the success. And
Thank you.
looking forward to doing some more stuff with you here in the future. And for all of you that are listening, thank you so much for checking out this edition of the REI Hacker Podcast. Tune in for future episodes where we bring in more experts in real estate investing and business and entrepreneurship like Matt. And yeah, give us some feedback, share it with some people, help us get the word out. There's lots of really powerful content here that will help you with motivation and different strategies, and ultimately helping us to figure out ways of making money in real estate. So thank you for listening.